Okay, let's unpack this. We are diving straight into the Q3 fiscal 2026 earnings for Phreesia Inc. That's ticker PHR. These results hit the wire after the market closed on Monday, December 8th. And the mission for this deep dive is to figure out one central question for you. Why did the market just aggressively sell off a stock that reported a massive profitability beat?
That paradox, that's the entire narrative this quarter. It's really something.
It is.
They delivered fundamentally strong financials, signaling this huge profitability inflection, and gave a really confident outlook.
And yet,
the stock immediately tanks. It declined, about 23% and set a new 52-week low?
On huge volume, too.
Oh, yeah. 8 to 9 times its normal volume. So our job here is to really dissect the anxieties, the structural anxieties around debt, M&A, and regulation that just completely overshadowed those stellar numbers.
Let's start with that stellar beat, because the numbers themselves were unequivocally strong. When we look at the GAAP diluted earnings per share, they hit 7 cents. That is a truly dramatic swing from a net loss of 25 cents this time last year.
And if you look at the non-GAAP number, which, smoothed things out a bit, they came in around 10 cents per share.
Which was way ahead of expectations.
Way ahead. It utterly erased the street's consensus. Everyone was looking for a loss of about a penny. Revenue, a little less surprising, but still solid.
Came in at $120.3 million, 13% year-over-year growth, pretty much right on the money.
Exactly. So they crushed the profit line while keeping that top-line growth steady. It really signals that their focus on operational discipline is paying off big time.
And you can see that leverage in the net income line.
Sure can. Net income was $4.3 million. That's the second quarter in a row of GAAP profitability. So this is looking like a sustainable story, not just a one-off.
But the real kicker was the adjusted EBITDA margin.
Ah, yes. That's where the story really gets interesting.
Tell us about that margin. That's where the operational leverage truly shines.
Okay, so it jumped from just under $10 million a year ago to $29.1 million this quarter.
Wow.
The resulting adjusted EBITDA margin hit an all-time high of 24%. To put that in perspective, that's a 15 percentage point improvement year over year.
And sequentially.
5 points quarter over quarter. They're driving efficiency at an accelerating pace. And on top of that, they just completed 5 straight quarters of positive operating cash flow and generated strong free cash flow of $8.8 million.
So a GAAP profitable, free cash flow positive business.
Exactly. This sounds like a company that's firing on all cylinders.
Right. And operationally, the core business looks healthy. Average healthcare services clients, or AHSCs, up 7%. Revenue per client up 6%. Management's message was strong execution, profitability inflection. Yet the stock sold off 23%. This is where the deep dive really begins.
Right.
Why did the market completely reject this?
It really comes down to 2 things: the debt they took on for the AccessOne acquisition and the suddenly cautious guidance for their fastest growing segment.
Let's start with the acquisition.
Yeah.
That introduced a big new variable.
A very big debt-shaped variable onto a previously clean balance sheet.
Right, the AccessOne deal. This was a roughly $160 million acquisition for a patient financing platform. The idea is to help providers with all the money patients owe them.
And a strategic logic, it makes sense. Providers are struggling with cash flow.
So how did they fund it, and why did that structure create so much anxiety?
The structure is the key. They used about $53 million in cash, which is fine, but then they took on a substantial $110 million secured bridge loan.
A bridge loan? That's short-term.
Short-term and expensive.
Yeah.
It's a signal that they have to refinance it quickly into a proper long-term facility. And because it's secured, it puts pressure on their assets. It just instantly shifted the market's focus from their great profits to, debt management and refinancing risk.
Even though the strategy seems sound, providers have seen their cash on hand drop almost 30% since 2022. They need this kind of help.
They absolutely do.
Yeah.
But here's the critical nuance, the thing that raised a huge red flag for investors on the call. Management explicitly admitted that the current AccessOne product is, and this is a quote, not appropriate for the vast majority of their existing clients.
Wait, what? If the whole point is to cross-sell into their huge client base, why isn't the product ready?
That's the million-dollar question, or I guess the $160 million question. It suggests a lot of technical complexity. It's not just plug and play.
So what does that execution risk actually look like?
It means they have to do a lot of work. They need to integrate it deeply into the Phreesia workflow, maybe new software, new training. Management admitted it requires significant product and go-to-market investment, before they can really start selling it.
And all that spending is already baked into their guidance for next year.
It is. They basically bought the engine, but now they have to spend a ton of time and money building the car before they can actually sell it. The market is pricing in that cost and that delay.
That's a huge risk. So to counter that, they highlighted some organic growth drivers, especially AI and new marketing stuff. Let's touch on VoiceAI.
Right, VoiceAI. That's their AI-powered call management system. They're pushing this as a way to get more money from each client without having to hire more people.
So using tech to scale instead of headcount.
Precisely. It's all part of that operational discipline story.
And the second big push is into healthcare provider, or HCP marketing. This is their angle to get pharma ad dollars without getting caught up in the chaotic world of direct-to-consumer advertising.
Exactly. They're using their position inside the doctor's office on the platform to engage physicians with relevant content right before a patient appointment.
So it's very targeted.
It's all about context. They think this is a more durable, differentiated revenue stream that's, maybe safer from any broad regulatory crackdowns.
Okay, so that operational discipline is what drove the great Q3 numbers. But let's get to the second major anxiety, the guidance. This seems to be what really triggered the sell-off.
I think so. You have to look really closely at the updated numbers for this fiscal year, FY26.
They tightened the revenue outlook to between $479 and $481 million.
Right. And management specifically told us that the new AccessOne business is going to bring in $7.5 million in revenue in the fourth quarter.
Okay, so wait a second. If they just added $7.5 million in new revenue, but the midpoint of their total guidance only went up by about $3 million.
You got it. That implies a $4 to $4.5 million headwind somewhere else in the core business. A sudden, unexplained slowdown.
And where did they say that slowdown was coming from?
They pointed the finger directly at their fastest growing segment, network solutions. They said there was fluidity in pharma marketing budgets and pointed to the regulatory talk around DTC advertising.
They're building in a cushion.
A big one. But it makes you wonder, if the core business is suddenly seeing a $4 million headwind, why should we trust the aggressive projections for next year, which depend on that same segment being their fastest grower?
That's the disconnect. That's what the market is pricing in. A loss of confidence.
That's the friction point, absolutely. Yeah. Management confirmed on the call that organically, Network Solutions is still expected to be the fastest grower in FY27. So its success is critical.
Speaking of FY27, let's lay out that initial guidance. It's aggressive.
Very aggressive. They're projecting revenue of $545 to $559 million. That's 14 to 16% growth.
And how much of that is the new acquisition?
AccessOne is supposed to be about 6.5% of that total. So they're still expecting solid mid-teens organic growth. And crucially, they're guiding to adjusted EBITDA of $125 to $135 million. The margin story continues.
So if we put this all together, the market is essentially saying, great quarter, guys. We believe you can be profitable, but we don't believe you can handle this acquisition and these regulatory headwinds at the same time.
That's a perfect summary. Investors are aggressively de-risking. They're focused on the AccessOne integration risk and the regulatory overhang. The stock is now firmly a show-me story.
And for the stock to get back on its feet, it seems like investors need to see a few things happen.
There are three major checkpoints they need to clear.
Checkpoint one has to be the debt, right? They need to refinance that $110 million bridge loan.
Paramount. Getting that replaced with a normal long-term loan takes so much pressure off the balance sheet. That's number one.
Number two would be proof that the acquisition is actually working.
Tangible evidence. They need to show real cross-sell success into their existing client base. Show that the investment's paying off. Right now, the market is pricing in zero synergy.
And the third, which might be the biggest hurdle, is proving that Network Solutions can weather this storm.
Exactly. They need to demonstrate the durability of that demand. Management believes their model is on the right side of any new rules, but the market is clearly selling first and asking questions later.
What's really interesting here is the split between the analysts and the actual traders.
There's a huge disconnect. The sell-side analysts at the big banks, they mostly kept their buy ratings. They see this as the stock just getting cheaper, not that the whole story is broken. Their price targets are still way up in the high 20s or mid 30s.
But the trading volume?
The volume tells you the buy side, the big funds, the hedge funds, they were dumping the stock aggressively.
Yeah.
So you have this massive disagreement in the market right now about what this company's actually worth.
And that disagreement is what makes this a really compelling situation to analyze. And now, for the segment where we remind you that nothing we discuss here should be taken as personal investment advice. We're simply exploring the details of the call and the market's reaction to give you some analytical insight.
With that disclaimer out of the way, let's pitch a trade idea based on this dramatic disconnect.
I'm listening.
The company is fundamentally sound. I mean, it's GAAP profitable, it's free cash flow positive. The stock is selling off purely because of fear, right? Fear of the integration, fear of regulation. That's created a huge valuation gap.
So what's the actionable trade?
Go long PHR. You buy the stock near its 52-week low, around $15.50. You are betting that the management team that just proved it can drive massive operating leverage, can also successfully execute on removing this debt problem.
And the catalyst is that refinancing.
That is the single highest impact near-term catalyst there is. Management has to address it in the coming months.
What's the rationale for the re-rating?
A successful announcement that they've replaced that expensive bridge loan with a normal long-term loan immediately takes away the biggest fear. It solves the balance sheet anxiety. That should be the first narrative shift that allows the stock's multiple to expand back towards those analyst targets, in the high 20s. That's substantial upside driven by fixing a technical problem, not a fundamental one.
So to wrap up our deep dive, Q3 was a massive profitability milestone. They took a big strategic step with AccessOne and laid out an aggressive plan for next year. But the market is demanding proof. Proof that they can handle this M&A integration and navigate the turbulence in their most important growth segment. Until then, the stock could be stuck.
And that raises a really important question for you, the listener, to think about. The company has explicitly said their priority right now is paying down debt, not buying back stock. So the question is, how quickly can that strong free cash flow they're generating actually be used to pay down that AccessOne loan and prove to everyone that the balance sheet is truly strong?
That balance sheet strength is the key. It's what will unlock investor confidence. We appreciate you joining us for this deep dive. We'll catch you next time.